Leanne, are we good to begin? All right. I'd like to welcome all of you. Is this working? All right. Welcome all of you to our final session of the first day, where we're going to honor the 2021 Distinguished Fellow of the History of Economic Society. For most of the people in this room, and in fact, most of the people in our field, our speaker this afternoon, Cristina Marcuzzo, needs no introduction at all. After all, she's been a consistent presence, and in fact, really a force in our field for several decades. She was educated in the humanities, the philosophy of science, and economics at Milan and at the London School of Economics. She's held faculty appointments at Medema. Where's Maria? There she is. Your hometown, I hear. I did not know that until Cristina just told me. Calabria and Udine, before taking up a position at the University of Rome, La Sapienza in 1994. She spent roughly a quarter century there, including a 6-year stint as department head, always a thankless job, before her retirement in 2018. And she now serves as an honorary professor at Roma. But to say Cristina's 25 years at Roma were spent at Roma would be a lie. She's been, as much as anyone, a globetrotting ambassador for the history of economics, participating in a mind-boggling number of conferences and workshops around the globe in countries too numerous to mention. I tried to count with conferences. I quit at 140 countries. I didn't even bother to try. She's held visiting positions at places including, and this is just a few of them, Berkeley, University College London, LSE, UCLA, and of course, Cambridge. She literally has been everywhere. And I have a lot of frequent flyer miles traveling to economics conference, history of economics conferences. And Cristina makes me feel like I've never left the house. It's truly amazing. She's passionate both about growing the field and about bringing together historians of economics from around the world, cognizant of the myriad intellectual, professional, and personal benefits that flow from gatherings such as this and are such a big part of why we're here today. Largely successful in those efforts. Your attempts to create a World Congress never managed to come off. We tried, girl. We did try, but time and time again, it failed. The numerous international research projects that she's been involved with, and indeed played a key and often leading role, some of which I've had the privilege to be involved with, are ample testimony to the success of these globetrotting efforts. And in all of this, Cristina has been a tireless champion for young scholars, which is the future of the field. Of course, it's something near and dear to my heart, a legacy in my life of the great Warren Sanders. Cristina is a tireless champion for young scholars, enfolding them into our community, mentoring them in their research efforts, and creating opportunities for them whenever possible. Given the amount of time she spent on the road, Cristina's record of scholarly publication is simply astounding. She's published more than 100 articles and is the editor or author of more than 24 books. I can only assume she writes very well on planes, trains, and in hotel rooms. Her scholarship is the product of careful textual analysis and dogged pursuit of archival insights. Most of this work, as you all know, or if you didn't, you figured it out from her talk last night, deals with the ideas and lives of economists in and associated with Cambridge and the Cambridge tradition, as exemplified in the works of Marshall, Kahn, Robinson, Koletsky, Sraffa, and of course, Keynes, the subject of her talk today. I could go on at length about all of that. I'm not going to. It would simply take too long. When you didn't come here to hear me, you came to hear her. But there's something else I need to say. Cristina came of age when our field was very much an old boys club. To her credit, and to the great benefit of subsequent generations of women in our field, Cristina has a bit of a hearing problem when it comes to the word no. And so she has carved out a remarkable career, one that includes serving as president of the European Society for the History of Economic Thought, in fact, actually its first female president, and of the Society for the History of Political Economy, or STORA, in Italy, as well as a member of the HES Executive Committee and of the board of the Society of Italian Economists. It's perhaps no secret, and it certainly isn't to the two of us, that Cristina and I view the history of economics through rather different lenses, with dramatic implications for our respective understandings of that history. Even so, we have a close friendship that extends back some 25 years, and it has been an honor, and I mean that, to work with her on efforts to promote and grow our field. Our politicians these days can certainly learn something from our relationship. It thus gave me great pleasure to learn that Cristina had been named a Distinguished Fellow of the HES, and it's a privilege to be able to have here with us today, Cristina Marcuzzo, to speak about investment and speculation, Keynes's views and his strategies in the stock market. Given where the market has been moving of late, I encourage you all to pay very close attention because Keynes is actually pretty good at this stuff. So please join me in welcoming Cristina Marcuzzo, who I will also present with the plaque recognizing your selection as a Distinguished Fellow of the HES.
So, what Bruce said this morning, I don't think I ever had such a nice introduction. Thanks, Steve, and indeed, I treasure our friendship, who have traveled many ways over the years, and I'm particularly delighted that you are the one who introduced me here. I want to start by saying how deeply honored I am for this award that's been given to me, and I just checked. This is the 30th anniversary of my coming to the HES, first time being at George Mason in 1992, and I checked the session, and Ross was chair of the session that I presented the paper who got the award as the best article, I think was the beginning of that. So I'm very much in debt to the HES Society for all the honors that have been bestowed on me, and I consider this my community as much as European Society for the History of Thought. I don't feel divided loyalties, I feel loyal to both, and very grateful for the kind of honor that you have given to me. Thank you very much indeed. Now, can I just move, I just to share screen together? Is that okay?
Yep.
All right. So I will basically read out just to save time, since the material I'm going to cover is pretty wide. So I hope to remain in time by reading out most of. Why doesn't it go on? Sure. No, it doesn't. Anyway, it's stuck.
Move the cursor bar above with a little picture of the screen.
No, I'm
Right over there, you're close.
That could,
no, it doesn't move, but it did move before.
no.
Go back to the bar on the inside box.
Okay.
Okay.
I just wasn't recognizing that.
Thank
Meeting control.
Keynes depicted a world of uncertainty, but still a world in which decision must be taken, be it in the political, economic, or moral sphere. He denied that the same rule can be applied to all circumstances or in every domain. So relegating economic rationality, implying full knowledge and therefore a condition of lack of uncertainty, to a much restricted scope. However, his approach should not be interpreted as a lack of faith in the possibility of making decisions rationally, rather than randomly or without any anchor to some principle. In fact, the most important guide to decision making on the basis of his view of probability were for him knowledge and information. In this presentation, I look at his views on investment and speculation in the stock market, drawing both on his written work and his lifelong activity as an investor and speculator, and also, of course, his practice as an actor in this market. I draw on work that I have done over the years, often in collaboration, on Keynes as an investor and speculator, on the basis of published and unpublished papers, ledgers and correspondence found in his paper at King's College, Cambridge. As Steve mentioned, I think I spent 20 years, summers, not years, 20 summers looking into these archives. And I came up to this material quite recent, 10 or 12 years ago. And that's what started my interest in his work as a speculator, because this was completely recognized material. First of all, because as you will see, it was very messy. And there need a lot of patience to go through them. So what are his case papers? They include statement of accounts sent by the brokers to Keynes, notes and computation handwritten by Keynes on dealings and profit on each company across time and correspondence with brokers, exchanges published and unpublished with other investors and businessmen, containing views or consideration on specific companies and the US market, open position, valuation at each date, and manuscript ledger. A fundamental source of information on Keynes holdings are the valuations of his security portfolio, including both British and US at the end of each year, made by Keynes himself in his ledger and statement of account, relating to Keynes' position at each day by Bookmaster and Moore, who was Keynes' main broker for his investment activity in financial market. On New Year's Eve, Keynes used to sit down in King's College and make calculation on his investment, rather than going to some party at the end of the year. That was his spend. That's how he spent his time. And just to give you an idea of these archival sources, these are, for any of you who would fancy to go back and check them, this is where you find the evidence. But more interesting, I wanted to show you what kind of document you have to go through. First of all, you have to find out the first years, the handwriting is not too bad, but sometimes it becomes scruffy because of, the way material. This is statements of that. By the way, nothing is typewritten until the mid-30s, so 20s and early 30s, all handwritten. Makes life not very easy for anyone who wants to go through them. And this is one of the reasons why this material, I believe, has not been studied earlier on, and you need only some manic attitude to be able to, which obviously I had. Okay, Keynes started up as an occasional investor in the stock market when he was very young. After 1919, thanks to the proceeding of the best-selling economic consequence of the peace, which, by the way, I think sold for 100,000 copies. That's where he got his money to start with. His dealing grew in magnitude as well as scope. Currency speculation became the main business for a while, leading to serious loss in 1920, which Keynes had already recuperated by 1922, thanks to the revenues coming from speculation in commodity, metals, and cotton. And just to give you an idea how he was confident in his ability, when he lost all this money in the 20s, he wrote to Castle, which at the time was also the banker to the Queen, saying, if you lend me the money, I'm sure I will be able to repay you in a couple of years' time, which in fact he did. So he was quite sure about himself, and sometimes overdid it, but that was the attitude that they took. In fact, commodity speculation took the lion's share during the 20s. From 1921 onwards, he dealt heavily in cotton and metals, tin, lead, copper, and spelter, and then in cereals, wheat, corn, maize, rubber, sugar, lard, cotton oil, linseed oil, mainly through future contracts, but also through options, especially in metals. His trading was particularly intense during the old decade and extended late through the 1930s, although on a smaller scale. In fact, he went on trading commodities until the closure of this market on the eve of the Second World War, 1939. On much larger scale was Keynes' exposure on the London and New York stock market, where he was active from the early 1930s until the time of his death in 1946. Although he had tried his hand in the London Stock Exchange since the early 1920s, he became a serious investor in shares and bonds only after 1932, when the London Stock Exchange rebounded after the 1929 collapse. The number of companies in which Keynes invested in the London Stock Exchange was likely over 200, with a great variety of instruments, regular shares, preferred, debenture, and other fixed interest securities. The sector of investment were mining, industrial, transport, finance, soft and raw materials, local government, corporate bonds, plus a few shares in utilities and new technology. He tried some sporadic dealings in US companies before the 1930s, but it was only after 1934 that his American dealings grew significantly, and especially after Roosevelt election, of course, his interest in the American economy grew larger. 4 sectors stand out in this US portfolio: utilities, investment trusts, mining, and oil, besides sectors such as the motor industry and various industrial and consumer good industries. Parallel to his personal investment activities, there was an intense career as an institutional investor. In 1921, Keynes became second bursar of King's College, Cambridge, and then first bursar in 1924, a post he retained until the end of his life. And that's where most of the work has been done, especially by Chambers and others, on Keynes as an investor, because these are nicely accounted, very clearly typed, and that's where the fame of Keynes as great investor derives, because he persuaded college, at least on the part on which there were discretionary activity, to invest in shares, which was a completely novelty at the time. And that's where Keynes became famous as a great investor. He became, then, besides his college, he became director of National Mutual Life Insurance Company in 1999, then chairman in 1921 until October, until the beginning of the war, when he started working for the Treasury, and so he left out most of his activity as investor. He then joined the board of Provincial Insurance Company, which is nice because we have a lot of records, very nice record, which were the basis also of a nice book that came out, and then gives a lot of information about his activity as an institutional investor, particularly his attitude in the board, where most of the time he found hostility because people felt that he was, as it was said, riding the tiger rather than being a prudent investor. And then he was director of independent investment company, the ID Investment Trust, finance company, and so on. So the point that I'm trying to convey to you is that Keynes' practical acquaintance with stock market shaped his idea about the working of future markets in particular, and financial markets in general. And in turn, his idea influences strategies as an investor in this market. So in what follow, I try to look at these connected aspects of his investment behavior and philosophy together with his view as an economist. And I try to conclude to link them up with some consideration of Keynes' approach to decision-making and choice, which is what I will start out in the beginning, that in a world of uncertainty, you still have to make decisions. The fact that there isn't uncertainty does not allow you to get away with the fact that you have to decide. And we try to link this with this philosophy. Okay, so let's start with Keynes' view as an economist. And I will start from the very beginning, on his lectures on the stock exchange, when he did not have any practical experience as an investor. And he was asked by Marshall to give that course. He went through, I think, some ready reading, and Emery basically was his best book, but he didn't know anything about practical stock exchange. As most professor, he was teaching something that he didn't know as a practice. And in that lecture, which are unpublished by the way, Keynes distinguished between gambling and speculation, applying the former term to situation in which risk is or is not calculable. The dividing criterion between gambling and investing was the amount of knowledge, according to him, possessed by the actor in both cases. And he wrote, the possession of superior knowledge is the vital distinction between the speculator and the gambler. Superior knowledge conferred the speculator with an advantage over the market. To Keynes, this is a matter relevant, not to measuring comparative success in gambling and speculation, which may be dependent on another factor, but to evaluating the nature of the decision or the action in the two cases. The interesting point is that for Keynes, unlike speculation, gambling is a behavior which has no basis in knowledge, notwithstanding the fact that the gambler may at times be a winner and the speculator a loser. Does this superior knowledge allow the speculator to predict the future course of events, was the main question. And there are passages in this early work that seem to confirm it. Speculation, he said, is a reasoned attempt to gauge the future from the present known data. The speculator is a person who endeavors to make a profit by means of a power of forecasting the future, which is superior to the ordinary. And again, speculation consists in the use of superior skill in forecasting changes of value or take advantage of them by buy and sell. So these first phases, when you didn't have any practical knowledge of stock market, or just teaching, that's the way in which I approach the matter. Again, speculation has to do with, as a firm basic knowledge, and that's allowed the speculation to have advantage of the market. The next phase, I call it stage 2, in his thinking, when he became more closely acquainted with the working of market, was the analysis of speculation in future, currencies and commodities, which, as we all know, was presented in his 1922 article, The Follower Market in Foreign Exchanges. Then he was incorporating the track of monetary reform, and in his 1923 article, Some Aspects of Commodity Market, where first he presented what is known for the theory of normal expectation. The point here of speculator is defined as a risk bearer, and this definition is reiterated in the Treatise on Money, where he gave a more refined version of his theory. So what now changes in his interpretation of speculation? The speculator is not a gambler, but his ability as superior knowledge is a little bit downplayed. He's not a prophet. He's not a prophet any longer, someone who can predict the future, but rather a risk bearer. The most important function of the speculator in the great organized future market is risk bearer. So at this stage of Keynes thinking, speculator profits are seen as a remuneration for taking risk, for risk bearing, not for forecasting skill. So you can see there is a change. And the theory of normal backwardation explains precisely this, explains the risk premium, which speculators demand, and which is defined as the difference between the expected spot price, which is of course not observable, what speculator has in mind, and the forward price, representing the compensation for assuming the price risk that is shifted through derivative contracts from the hedgers to the speculator. In general, demands for risk transfer come from individuals both with long exposure, people who are long, basically producer, and short exposure, basically consumer, in the underlying commodity. If market conditions are such that the short derivative position prevails, there will be a downward pressure on forward future prices. The important implication of normal backwardation is that the quoted forward price must fall below the anticipated future spot price euros in the treaties. And he adds, it is not necessary that there should be an abnormal shortage of supply in order that the backwardation should be established. If supply and demand are balanced, the spot price must exceed the forward price by the amount which the producer is ready to sacrifice in order to hedge himself, i.e. to avoid the risk of price fluctuation during the production period. Thus, in normal conditions, I think it's important that just in normal conditions, the spot price exceeds the forward price and there is backwardation. In other words, the normal supply price on the spot includes remuneration for the risk of price fluctuation during the period of production, whilst the forward price excludes this. Then, of course, you can, in other situations, you just do not have necessarily backwardation. You can have contango, because we have a positive cost of carry due to the cost of the warehouse, depreciation, interest changes, indicating an expected increase in the spot price over the excess of physical and capital storage cost over the convenience of liquidity yields. But on top of that, the spot price in a contango situation is expected to rise still further to provide an additional compensation to long speculators for accepting risk transfer. In fact, in the general theory, it is clearly stated that the relation between the spot and future contract as quoted in the market is notoriously different for different commodities. So the point I want to stress is that Keynes' theory is always associated with normal backwardation, as if this be the normal condition. This is a condition that arises only in particular circumstances due to the difference of supply and demand condition, but particularly condition different for different commodities. In fact, behind the normal backwardation, there are assumptions that which may not hold. Hedgers are not always, and they rule long the physical asset on average. There may be purchaser of a commodity on the spot market and hedge its price risk with a long derivative position. And it's also possible that producer with long price exposure may not fully hedge because it's too expensive. So the impact on the future prices depends on the market participation composition. The main point is that since speculators are a mixed bunch, some of them may have superior knowledge and information, but having superior knowledge and information does not necessarily mean superior forecast skill. So there is no inconsistency between the view of the speculators as risk-bearing individuals and speculators with varying degrees of knowledge and information. In fact, the most important aspect which distinguishes the Vulgata version of the normal backwardation, X, and then goes on in the tradition up to these days, is that Keynes' approach in his fully developed analysis is that it allows for individual differences in expectation, beliefs, and information evaluations. So it's not a mechanic rule, it's not a mechanic outcome. It depends very much on the market condition, but in the nature of belief, expectation that each speculator entertains. The set of conjecture upon which decisions are taken are subjective. They are related to individual varying degrees of confidence in those beliefs. It's not just the beliefs that matter, but how confident you are in your beliefs, which in turn reflect how individuals experience reality. And this is approach, of course, that derives from Keynes' theory of probability, the variability in the confidence in expectation, both among individuals and within each individual, has an impact on our expectation and then transmitted to market, which may convey signal to individuals to revise their expectation. And this is the case, of course, of beauty contests, you know, when people react to other people. It is to be noted that the risk premium is paid as a reward and incentive for taking a risk above the risk-free rate, not a reward for predicting market movements. Again, is that someone who's is paid for taking a risk, not because he has an ability to forecast the future prices. It is a conjecture incorporated in the expected spot price. Remember, expected spot price is not observable. It is in the mind of the speculator, okay? And so this conjecture, which is incorporated in the expected spot price, calls for a reward, making the future price, which is observable, because of course there is a market, the future market, so makes it diverge from the expected price, which is unobservable. What we observe in any given moment is not the price expected to prevail at the future date, because this is an expectation which is individually related on the basis of belief, knowledge, information, and so on. But it is the price which is sufficient to induce speculators to undertake the risk, given their expectation of what the spot price will be on maturity of the contract. The problem, as everybody knows who's been working on this future market, is that extracting information is difficult in practice. It's very difficult in practice to extract information and even to test speculation. And that's why there's been so much controversy over the theory, because if you try to test it empirically, it's not easy to find it. As a matter of fact, you can find it. And that has led to the idea that Keynes theory is wrong, because it cannot be. But if you interpret the theory of backwardation the way in which I've suggested, I don't see there is any inconsistency. So according to Keynes, the risk premium is the best estimate we can make of probability. And there is a very nice letter to Hugh Towson of December 1938, in which he said, I'm rather inclined to associate risk premium with probability, strictly speaking, and liquidity premium with what in my treatise of probability I call weight. Remember, a treatise of probability is the weight of the argument. You know, how confident you are in the belief that you have. An essential distinction is that the risk premium is expected to be rewarded on the average by an increased return at the end of the premium. A liquidity premium, on the other hand, is not even expected to be so rewarded. It is a payment not for the expectation of increased tangible income at the end of the period, but for an increased sense of comfort and confidence during the period. This, of course, the liquidity premium, because give you security, no? It's the liquidity premium is the sense that being liquid is the best insurance against the future uncertainty. Then we have the third phase, and this is the general theory. Because there the analysis of speculation marks a departure from Keynes' previous view. The term speculation is appropriated for the activity of forecasting the psychology of the market, and it is distinguished from enterprise, which is defined as the activity of forecasting the prospective yield of assets over their whole life. And Keynes said, as the organization of investment markets improve, the risk of predominance of speculation increases. And then, of course, we have the beauty contest, average market opinion, which is plain. Speculation does not promote price stability in this market. And unlike FAMA and efficient market theory, according to which by buying low and selling high, speculators push up the low prices, push down the high prices, Keynes points out it's possible destabilizing nature of speculation. And the destabilizing effect of speculation can be described as a large increase in optimism or pessimism propagated by herd behavior, unrelated to new information about fundamentals, but just triggered by market opinions. So in the general theory, Keynes made it clear how the energy and skill of the professional investor and speculator are mainly occupied not with making superior long-term forecasts on the probable yield of an investment over its whole life, but with foreseeing changing in the conventional basis of valuation a short time ahead of the general public. And this is, of course, how Keynes is usually interpreted. Herd behavior, uncertainty, market instability due to no certain anchors to behavior. I will try to show you, to persuade you, that this is only part of the story, because if you look at Keynes' strategy in practice, you can see that he had to make decision, and he made a decision on the basis of great knowledge and information. So let's have a look to his strategy in practice. Keynes always collected information relative to each individual market and assets, weighting the quality and reliability of that information through calculation of the relevant data, the advice of experts, his own assessment of market condition, and other participants' opinion. While the grasp of business psychology was an important element both in his investment strategy and his views on speculation, as he became more and more a long-term investor, he never lost sight of the fundamentals underlying the companies in which he invested. He showed a great versatility and flexibility in his investment behavior. He followed no routine or mechanical rule, except perhaps at the beginning of the 1920s, when he approached commodity market as a beginner. And in fact, he sought advice in 1921 from Robert Troughton, at the time also working for Bookmeister and Moore, Keynes' broker, who in a note, which is a very nice note, probably written in 1920, explained to Keynes what the options were. Okay? So he asked his student, can you tell me how the option works? And then, of course, he wanted to prove to be better than his student and start to work investing in option very heavily. The Keynes paper revealed hundreds, I'm speaking of hundreds of documents showing Keynes' need and passion to keep up to date with the market by constantly gathering evidence. They show also that for Keynes, investment was a time-consuming activity in which building up a network of reliable connection and collecting sound, relevant information was a costly but a decisive task. Keynes' portfolio choices, both personal and institutional, were the result of the juxtaposition of his general vision and systematic analysis of the entire economic system with the information he could actually obtain on sector and individual shares. He relied on a huge amount of detailed information on a selection of shares from a number of sources, providing him with professional as distinguished from confidential information and business analysis. In what followed, I tried to give you a brief summary of this investment, just a very sketchy overview. drawing on work which is much more detailed and is published. So if you're interested, I can give you the reference. And so I'll start with commodities, okay? Among the different commodity trade by Keynes in the period 1921, 1939, cotton, tea, and wheat appear by far the most important in terms of proportion of value out of the total purchases. More specifically, cotton loomed particularly large during the 20s, wheat in the 30s, and tin in the both period. Comparing the two periods, I will show you then some data in a minute. We can observe that the value of cane purchases in the 20s was about 3 times greater than in the 1930s. So the 20s were the commodity period, okay? Very important. And during the 30s, there was substantial increase in wheat future trading in Chicago, the exchange, America. I mean, it traded Argentina wheat. You know, wheat is the commodity that has all year harvest. So it was trading all over the place. And there is a decrease in future. And in the 20s, his portfolio was made up basically of 2 commodities, tin and cotton, while in the 30s, wheat future was about 50% of his total portfolio. From 1923 onward, he diversifies his dealing and did not adopt a simple renewal of long position, rollover, but frequently alternated long and short position according to his expectation, firmly grounded on careful analysis of the fundamentals. His trading confirms his tenets that backwardation should not be considered a permanent feature of the commodity future market. And so this is the proof the normal backwardation was considered only a special case. Otherwise, you could have followed just a rollover strategy. So Keynes seems to have been very well aware of the broader and specific circumstances which render each commodity, each marketplace a special case. And so just to give you a few data, as you can see, this is the 30s and these are the 20s. Just to give you a sense of numbers. His investment strategy changed in 1930s when, without losing faith in commodities, he reduced the scale by 2/3 and almost abandoned the riskier component of his commodity investment, while at the same time increasing his investment in stock market, operating in different markets and marketplace. He traded in the London Stock Exchange and Wall Street, dealing in shares of both American and British companies, for which he followed mainly, but not exclusively, a buy and hold strategy. Although never adopting mechanical investment scheme, it can be said that he abandoned the short type of investment behavior that he had in the 20s in commodity in favor of a long-term investor perspective. But he remained somehow keen on investing in commodity all his life. Both is in London and LSE, the London Stock Exchange and New York Stock Exchange, can show a remarkable consistency in his behavior as an investor. Factors like knowledge of the sector of company, often acquired through personal connection. Whenever he came to the United States, he wanted to meet banker, businessmen, politicians, just to have a sense of what the market was like. And of course, in UK, he did have all the connection. There was a master thesis done in Cambridge 3 or 4 years ago, in which I think they record that he corresponded something over 5,000 people. He had an amount of connection, even occasion connection, that was astonishing. So what were the factors that he looked at in making that decision? The solidity of the ownership, the trust in the management, together with the size and frequency of the dividends, were the main decision making. And in particular, I have done some work in showing that he trusts American management much more than he did the British management. And as a matter of fact, he invested in investment trust in the United States and did not invest in British. So he had a sense that the British industry was in a decline state, and he had great faith in the American company, even if he was disappointed by Roosevelt because he was not doing enough demand management, and even his policy with utilities was not entirely to his satisfaction. But just to give you an idea of what I consider to be his approach, we and my co-author, we call that the PET approach to investment. What is the PET approach to investment? So it's a subset of, in the case of America, 23 companies whose share he held for at least 4 years over a period of by 1932 and 45, and which represent only a quarter of the total number of companies traded by him in the period considered. These holdings account for about 3/4 of the value of his personal portfolio over the period. Okay, and British PET are a set of 38 companies whose share he held for at least 4 years over the period 1911-45, which are 1/5 of the total number invested in, which are around 200. So on average, the British PET accounted for 84% of his holdings, with a peak of 94 just before the outbreak of the war. So the better approach, and this is a nice quotation, which I think I'd like to read out. I myself follow very closely. I think I have some knowledge of upward of perhaps 200 investments. Now, out of the 200, which one tried to follow more or less, there are probably less than 50 note classes about which at any given time one feels really enthusiastic. And if you look at the PETs, there was never below 78%, reaching 90%. So you can say it was against diversification. Okay, so if you diversify, you don't know what you're doing. And this PET approach gives you an idea of what it's like. Okay, and these are where. Now, I give you again some numbers just to have a sense. I don't want to run out of time, but these are the numbers. So you can see the bets over there. And this is the weight of, see how much, this is the British portfolio. Now, the question that everybody asks me whenever I do the seminar, how good was it there? Okay, you're giving all of this theory. Now, this is how much money did he make, how good he was. Now, it is difficult to give an answer to this question because we do not have complete data on Keynes' personal portfolio over the entire period. And since these data are not regularly recorded and sometimes very difficult to decipher, are scattered in many files, so there is honestly a difficulty of coming up with and apply standard portfolio analysis. But I think that the kind of work I've been doing is being more interested in find out what kind of decision-making process was behind it and how we can assess him as an investor rather than come up with numbers and see how much he performed and so on. Even mortgage, he has some estimates, but it's very, 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 very sketchy. And so far, I don't think we are allowed, we cannot get a conclusive assessment of his overall performance. But we have some partial results, which I could give you. The literature basically has shown that he was sometimes very successful and sometimes lost a lot of money, as most investors know. And even if investment in options was only slightly success, and we calculated that he had a return of 3% over 12 years in a metal option, which the he had invested in government bonds, which actually added that he might not have the same fund that he actually speculated with. So this success, limited success in his investment in commodity, he didn't lose his general faith in the superiority of investment in commodities over other assets. And this is strange because, as you know, in the end, in 1938, he came up with the scheme of buffer stock for commodities, not trusting markets to stabilize prices. At the time in which, like now, commodity volatility is very high, he came up with the scheme of buffer stock because he believed that the future market were not going to deliver the good. And this is the discussion that we had over the 50s and the 60s on whether future market. And even work done by Chambers of his investment for Keynes show that sometimes a formal market, sometimes he didn't. So he was not the stellar investor of the story, but he was he was, I think, gifted as a trader, not in terms of the gains he made in the stock exchange, which were not as large as commonly believed, but by what I think was a great grasp of the fundamentals underlying price trend. He showed great ability in gauging the direction of prices. Also, he did not always get the timing right. I remember an old broker, friend of mine, once told me that he met so many people who were good in finding the right time to buy, and so many people were so good in finding the right time to sell, but were never the same people. And I think this is something that can be said about. Okay. So I'm getting to the close, and how do we know? What do we know, or what he said about his investment philosophy? Okay, so we have the theoretical part, investment, uncertainty, and so on. But we have also many public speeches and private correspondence in which Keynes promoted ex ante or justified ex post his investment strategy. And when he had to defend his positions and to defend his choices, he, of course, he wrote this wonderful memoranda, which are fantastic just because they allow us to understand what he said and what seems to be behind the decision making. But of course, when you justify ex post, is a different matter than how you came to that decision ex ante. So, although his investment philosophy seems to have changed in the early 30s because of the losses in commodity market, and possibly because the progress he was making towards the general theory, nevertheless, I think the role of informed opinion about the relevant data never gave way to evaluation of market sentiment, convention, and their behavior. In the end, the ability of the speculator rested for Keynes on individual judgment, as opposed to the average market view. My central principle of investment, he explained to 1944 to a banker who was very critical of the suggestions in which he was proposing to manage Eton, his college, finance. It was very critical. He said, my principle is to go contrary to general opinion on the ground that if everyone is agreed upon its merit, the investment is inevitably too dear and therefore unattractive. And he summarized his strategy to the chairman of provincial insurer, who was very worried because he was heavily invested in America at the time of the recession in 37. They were losing a lot of money. And the chairman said, look, we have to do something. And he tried to defend his position, and he presented that position early on. As the time goes on, I get more and more convinced that the right method of investment is to put fairly large sums into enterprises which one thinks one knows something about and in a management of which one thoroughly believes. And and this, I think, give us an idea of why it was not for diversification, but it was for this strategy. And let me finish by giving you a few quotation of the rules that he explained were at the basis of his investment. First is flexibility. I'm strongly opposed to rigidity. Fixed percentage, particularly within each group of industry, is surely altogether opposed to having an investment policy at all. The whole art is to vary the emphasis and the center of gravity of one's portfolio according to the circumstances, subject to a minimum in government security and a maximum in ordinary share. I would strongly urge the desirability of the greatest possible flexibility. Then, information. The very best principal investment, namely to pick a firm which one particularly likes within an industry and which one believes to be doing well. I should hate not to be able to invest in those in which I earn good accounts without buying at the same time a big bag of stuff about which I knew nothing or I heard less satisfactory opinion. And then narrow scope. I'm quite incapable of having adequate knowledge or more than a very little range of investment. Time and opportunity do not allow more. Therefore, as the investable sum increases, the size of the unit must increase. I'm in favor of having a large unit as market conditions will allow, and apart from a small group of security, this generally means smaller units that would be made necessary by the size of the investment fund. And finally, long time horizon. It sometimes seems to me that apart from the noble army of investor who never read the newspaper, I'm almost the only person left who has an investment rather than a speculative mentality. On every board I sit, on the great majority are influenced far more by the daily fluctuation which they read of the newspaper than by any reasonable calculation of the ultimate prospect. So let me get to the conclusion. The main feature of Keynes' approach to investment is the evaluation of the amount of information available for each individual asset and degree of uncertainty about the future course of the main factor underlying it. Interestingly enough, Keynes' focus on the evaluation of the information available remained a feature of his approach, both in his speculation phase, currency and commodities in the 20s, and his investment phase, UK and US share in the 30s. This continuity, I believe, is a reflection to his approach to decision-making and epistemology, which, while remaining fairly constant over the years, evolved also as a result of his practical acquaintance with asset market. Thus, for Keynes, decision-making is based on individual judgment deriving from real cognitive grounds, although these grounds are limited and partial. It is a judgment which has, at its cognitive ground, evidence or a reason in which one believes. This follows upon Keynes' approach to probability, which consists in inferring degrees of belief from the available evidence, and his criticism of probability identified with statistical frequencies, since frequencies are only a special kind of evidence and do exhaust the set of information upon which decision-making is based. From what we have seen, he was an investor who stood against general convention by bringing his knowledge and expertise in the decision-making, both when taking risks as speculator, guessing the direction of market prices, and betting on market sentiments, and when patiently was waiting for the yield of long-term investment. The analysis of Keynes practice shows that while he kept always an eye on the prevailing sentiments of convention, he in fact pursued and defended the strategy of long-term investor. This strategy does not mean disregarding the role of convention and guessing what the average market opinion was, but he remained foremost an economist who believed that knowledge and information about the fundamentals of the various aspects of the economy were the anchor for any rational choice making. Thank you. And this is a bit of it.
Thanks, Cristina, for a wonderful talk. Learned a lot. Questions? We have about 25 minutes. John.
Yeah, when you look at the archive, do you see a moment when the telephone comes in? Do you see, communications that used to be there between all these contacts, does it become visible that, oh, now it has telephone and the communication that you have in the archive falls off a bit, or it doesn't see that? It doesn't see that?
Well, of course, the time sequence is very tricky, right? Because what you have the ledgers, and you have the accounts, and you have the broker statement. But when did he make that decision? That's you just know when he did not pick up the phone until these people were against phone calls. They thought there was a barbarous victim, and they were not. But Keynes was an exception to that. So the story I was told by Richard Kahn, then when they were writing the general theory in Tilton, only during the day work, only two interactions were allowed. One was picking up the vegetables for dinner in the garden, and the other was the phone call with the broker. So he was in constant contact with the broker, Meister, and so on, but you don't know when he made exactly the decision, what triggered the decision. Exactly at one point, you just observe that in that particular day he bought and sold, but it's very difficult to find an exact point in time in which he said, "Oh, that's why." That was the question.
No, more. Do we know what year he might have gotten the telephone at Keynes? For instance, in other archives, I see a stream of telegrams of minor points. Then they get a phone, no more telegrams.
No. Written part. I mean, he was, of course, he was getting phone calls, but most of this thing was done by paper. So there is a lot of evidence, brokers, ledger, valuations, lot of stuff. So, but it's difficult to work on this material because he has, first of all, they are scattered in different places. And so, I mean, it's difficult, the kind of question you're asking. When did he make that decision? Which were the influence that made him decide to buy and sell or something like that? That's a difficult question to answer. We know how he justified, especially when there was an institutional investment, because he was challenged many times. You made that decision. Why should we invest so much in the US? Why should we buy this and that? And so he had to justify. But this is an ex post stuff. It's not an ex ante thing.
Others?
Cristina, thank you. Very interesting talk. So Keynes was a good Keynesian in words of fundamentals. But I wanted to ask you if you could, because I was very interested in what you said, if you think there was a change in how we approach these things with respect to this increasing awareness of the importance of intuition in things. And you said there was a bit of a debate. Do you think is investing a technique changed? Or how do you place intuition in this? It's a word you haven't used. So, thank you.
Well, I have always been convinced that there was a strict interaction between his practice as an investor and his theoretical development. Very difficult to see which was the direction, whether he, learn from practice and then he developed the theory, whether the theory had to follow practice. In the literature, usually there's supposed to be a break in 1932. And this is, of course, the year in which he started working with general theory, so you might say that might have an effect. And then there is a break again when he switched heavily into American shares in 1934. And then there is a break again in 1938 when he felt that commodity. So he was not somebody who had the same position all the time. Breaks. The only thing I think is consistent is that he trusted very much information and knowledge. And this is something I think is being a little bit underrated when Keynes is presented all about uncertainty, all about market sentiment and so forth. He was somebody who really believed in knowledge, information, and sometimes he was also accused to have a little bit of inside trading because he knew all these big shops in the city. I don't think that's can be good. Of course, knowing these people, for instance, he once said, "I'm invested in gold in South Africa because I know the man who's running the firms." And so he trusted the judgment of this as a big man. But it's not inside trading in the sense that somebody will tip him off with what to buy. So to answer your question, there are breaks, there are changes in the circumstances. It was a man who had the famous sentence, when I have new evidence, I change my mind. And that's exactly what he did as an investor. He had only one obsession as an investor, and I jointly wrote a paper on tin. Okay? He was obsessed by tin. Because tin he discovered in 1920, early 1920, and tin was like plastic, changed the way in which the war was conducted because food can be stored and so on. And throughout his life, he invested in tin, either commodities, the future, even the real commodity as such. And so there were some, besides the pets, like the companies that were respected because he knew a lot about them. That's the reason why they became their pets. The only exception was tin. I don't know why he was so much obsessed with tin, but and he lost a lot of money in tin, lost a lot of money in rubber, make a lot of money in lead, make money in some money in wheat and cotton. Some commodities was like on currency, he lost a lot of money. So his peak investment was in 1936, 37, and then lost money again. He died as a rich man, okay? But perhaps more for his paintings, for his, yes, portfolio was considerable, but this is not how he became rich, I think.
Anyone else?
I was wondering after your presentation whether Keynes' strategy in his institutional investing was different from his strategy in his personal investing. Did he have more freedom?
Yes, of course. His personal, sometimes he said, I made more money investing for my personal because I was able to make decisions less constrained. At Keynes, he had control only in the discretionary part of it. They would not, and in Provincial and the other companies, he had to negotiate with the other people on the board. And sometimes with Oswald Folk, he fell out because they didn't agree on the US investment. So he, with this Eaton, when he came to the board of Eaton, he wanted to change the strategy because again, Keynes was in this respect a revolutionary investor. Nowadays we know Harvard and we know, I don't know how it started in this country, when the colleges started investing in assets and so on. But in England, it was very late because colleges were very conservative. You invest in bond, you invest in land. And Keynes wanted to bring this new investment approach, institutional investment approach, by investing a lot in shares and so on. And he had to fight because people didn't believe that this is safe, basically.
Do you think he did better in his personal portfolio?
That's what he said, that whenever he, as I said, it's very difficult to have an overall, I mean, we're talking about someone who started investing in 1921, heavily, and died in 1946. Over this period, it's very difficult to say, well, he had, as all investment, as we all know, you know, was successful in some year, was less successful in, but it was heavily leveraged. The other thing one has to know, it was heavily, more than one time, his broker and his banker said, please, Mr. Keynes, can you cover your position? Because it was heavily leveraged. He invested on borrowed money. And so, and sometimes, you know, you can see that the broker getting a little bit nervous for that question.
It looks like there's a Q&A up there in the Zoom. Let's see if I can get to it. Thank you, Pedro, for pointing that out. Let's see. From John Hawkins. You all can read, so I won't read it to you.
Yeah. To what extent was Keynes' views published in the rest of the time? Do you think they viewed what pressures the market? No, not at all. I don't think so. I personally think that he was, as you all know, he was, there was one point in which there was a problem because he, as you all know, in public, he was trying to defend, talking about around the Macmillan Committee. He was trying to defend British industry and so on. So publicly, he would say things in support of British industry in private and in practice, in disinvested in it and buy American shares. So he had felt he had an obligation as a public figure not to speak against the decline of the British industry, but what he really thought can be seen in what he did, and he switched a lot from the UK. But I don't think that he ever had an influence on the market, because I don't think that not the thing for which he went public. It was much more government policy, interest rates, and so forth. Anyway, I said that what I've given you is a very sketchy overview of a research project that lasted 20 years ago, I think. Oh, not 20, almost 20. So you see. The distinguished fellows of this year are either many or serious scholars who spent 30 years on a subject before being outspoken. I shall put it this way. So I, together with my co-author, without whom I would have not been able to do this by myself, because the material is so complicated and so forth. So we've done work on single aspect, options, commodities, future, UK and US investment. And so what I've tried to give you is an overview, but I was trying to link it, given the audience, also to his view as an economist. But of course, if you are interested in knowing more in detail his activities, there are this work that we have been doing, which is much more specific and much more detailed that I've been able to give you in an hour time.
Yeah. So Cristina, thank you so much for the talk. It's always fascinating to see the results of your research. I'm curious just about, you mentioned this 1910 lectures that he gave on the stock market, right? And what exactly he discussed in that course, and how he followed the early literature of people thinking about the financial sector.
But what I know on the basis of biography, that he was asked by Marshall to do that course. He just sat down, read what Marshall told him to read, and gave a very, of course you can see that Keynes was already wanting to give his own approach, but the feeling you have is that he was just mastering the subject, contributing to the subject. And they are not published. I think part of them was, I think Anna Carabelli published part of them in some article there. So when if you want to read them, you have to go to the archives. They're not published. I don't find that particularly, I mean, I am not someone who believes that, Keynes from the early beginning, he was somebody who had already the wisdom, the ability to understand so on. So he's interested, as all biographers are, to find out. But I don't think that from the point of view of contribution, intellectual contribution, they are so important. I think they are much more important what he said, not just in his published work on the subject, but how he reacted each time that he had to justify, he had to produce, even as a person, he had to produce justification of the choices he made. He had to produce memoranda, letters, explanation, and that's where you can find out what he really thinks about it. Because this is a way in which you can see how his mind is trying to interpret. And he always been honest. He said, well, I made a mistake, but of course, we don't know if we had decided otherwise, whether we would end up in a worse position. So he's not trying to defend entirely what he does. But he's trying to give a rationale of why he did what he did. Whether this was a rationale that came ex post, they are called post-mortem. He calls them post-mortem. It's like the section. And whether this was a little bit of rationalization ex post might be the case. But I found that document, those documents, very illuminating of Keynes way of thinking about financial market.
But as he started playing with the market, was he reading also people who were writing about theories about the stock market and this kind of stuff?
Well, I don't think that he was reading a lot about the investment he was going to make. So, for instance, at one point he was interested in technology, new technology. What would you call it? Would be NASCAR man. So he wanted to find out why Aston Morris was doing better or worse than Ford, and went at length to be knowledgeable about the working of motor cars. So to spend time reading whether the way in which Austin Morris was going to outperform Ford. Or other example, he was interested in airplanes and foresee that airplanes was the future. So he got into that kind of information, to be knowledgeable more than a single firm. He would not look at the balance sheet, but the industry, how that industry was going to perform and whether. And then, of course, in the United States, he was very, very interested in utilities because of the reform of the New Deal. And he had some disagreement with policies, you all know. And he was enthusiastic about Roosevelt at the beginning, and then he became to doubt on his ability to do Keynesian policies, but also in his policy towards, for instance, he was very much against Roosevelt's attitude towards the big industry. He was not in favor of anti-monopoly and trust because he felt he would not give the incentive to these people to pursue. So, interesting enough, he didn't believe that competition was a way in which the system could be saved. And it's interesting because you would expect him to be in favor of the antitrust policy. He wasn't. So it's a complex, picture of how he thought and how he believed. But I think I want to say that by working on this material, which I echo Bruce, when you work into material that is not usually available, and then it changes a little bit the way in which the received view that you have, either on the man or on the subject. So a plea for the manics, if you do that kind of work, it's really enriching your knowledge. It's really enriching and allows you to exploit your curiosity in a sense that I think is rewarded in the end. Is rewarded in terms of what you learn and so on. But you have to have that manic drive. You don't get into this trouble.
Sure. Yeah, so I was trying to think of other ways to evaluate his performance, and maybe this is crazy, but I was thinking that have you or have anyone ever looked at his tax returns? Like, do we know what income he made, what, you know, earned, unearned income in the United States? Right?
Well, he had, well, it was not it is not as documented in his papers that we would expect, because he then at one point for tax purposes, he set up a Tilton company. Okay, so some of his investment were done on behalf of Tilton company.
But it's personal?
Well, he set up a company just to make investment for tax purposes. Okay.
And there are no tax returns on that?
Well, I haven't had all these documents. Perhaps they somewhere, we couldn't find it. We couldn't find a consistent set of records that would allow us to come up with some definitive result. Maybe we didn't look enough carefully. You know, we're very engaging in trying to decipher all these documents, and you know, they are not nicely put together in one bunch. So for 1 year, you have to find out whether he was investing in commodity, and he had just a notebook that he wrote the kind of investment that he did at the end of the year. So we don't have material that is consistently organized to find out. But perhaps you know, we didn't look carefully enough for this tax return.
Oh, thank you. Through the lens of your research, when we're looking at his investment practices at home, abroad, do you have that feeling? I always have, for example, when I read that 1933 year piece on national self-sufficiency, when actually it's written primarily for public purposes.
I'm sorry, because of the mask, I could not hear exactly what you were saying.
Oh, sorry. 1933 year article.
Yeah,
Actually, short one on national
yeah.
self-sufficiency. When you look at this article or assess this article through the lens of your research of his investment practices, how do you feel about it? Is it just right, you know, very short-term deviation from his globalization support, or is indeed some sort of, because I know right now in some quarters, indeed, that national self-sufficiency is considered as probably something which was overlooked in Keynesian scholarship. But from what you discovered,
The spur of the moment, I don't come up with any answer to your question. As I mentioned, Keynes' public figure, when he had to speak to the public, when to write about it, he had always in mind the reason why he was saying something. Okay? He was in that sense is very much like a politician. He had in mind his audience. He had to persuade somebody. So maybe each time that he set up to write something, he had in mind the purpose for which he was doing it. And as I said, in the case of before the Macmillan Committee, he was saying something about the British industry, that he had faith in his recovery, and so on. But at the same time, we know that that's exactly the moment in which he started disinvesting in British. So I'm not sure whether, I think that his investment practice and activity reflected one side of his life, and not necessarily in accordance with the other part. You know, Keynes had many hats as an investor, as a politician, as a man of arts, as a scholar, and so on. And all these identities somehow not always are consistent one with the other. He was in favor of the war and then financed Duncan Grant as an objector, which again doesn't seem to fit. He was against and accepted to become part of the government. He was a Bloomsbury person and then he became part of the establishment. So there are many dimensions that not necessarily fit all together nicely.
Thank you.
Yeah,
Thanks.
All right, I think we are now out of time. I think Ross would want me to recommend to you all that as exciting as these two great presentations today have been, the business meeting, which follows at 5:45, maybe even more exciting. Ross is nodding his head yes, and so I encourage you all to have only a quick break and then come back for the meeting where we conduct some of the business of the society. Again, Cristina,
Thank you. Thank you.